Oil refining is a crucial step in the energy supply chain, directly influencing the price consumers pay at the pump. The U.S. refines nearly one-fifth of the world's crude oil, about 18.1 million barrels per day. However, in the past 3 years, U.S. refining capacity has dropped significantly, putting a strain on both domestic and international supplies of refined oil and raising energy prices globally. If these trends persist, the U.S. refining industry will face significant challenges, affecting millions of Americans. Global demand for liquid fuels is projected to rise by nearly 20 million barrels by 2050, from 101 million to over 120 million barrels, according to the U.S. Energy Information Administration. This surge underscores the need for strong refining capacity to meet both domestic and international needs. Refining capacity isn't just an economic concern. It's critical to American energy and national security. Despite the ongoing demand for liquid fuels, a government-led energy transition in the U.S. and Europe could reduce local refining capacities. In contrast, regions like Asia, the Middle East, and South America are expected to increase their refining capacity, potentially shifting the balance of global energy supply and affecting American energy independence. Moreover, the boom in hydraulic fracturing and affordable feedstock had boosted American refining production over the last decade. Under a pro-development regulatory environment, the Trump administration saw an increase in refining capacity before the pandemic, with refinery production rising to 18.97 million BPD, making the U.S. a net energy exporter. In 2019, gas prices averaged $2.25 per gallon, compared to $3.74 per gallon in October 2023. Without adequate refining capacity, the U.S. risks a fuel supply crisis. The diesel shortage of 2022, which saw near-record low inventories and record-high prices, highlights the importance of refinery production in maintaining economic stability. The national average price of diesel has since fallen, offering some relief, but the situation underscores the volatility and importance of maintaining sufficient refining capacity. High gas prices have a broader economic impact. When fuel costs rise, consumers spend a larger portion of their income on gasoline, leaving less for other purchases. This reduced spending affects businesses like malls and shopping centers, as people tend to drive less. Studies show a direct link between driving miles and gas prices, making it challenging for everyday Americans to support themselves when fuel costs are high. Less disposable income means reduced economic activity, affecting the overall economy. So, in today's video, let's explore the reason behind why U.S. refineries are making record profits amid of a potential recession. Capacity constraints in the U.S. refining industry present significant challenges that ripple through energy prices and the broader economy. Building or expanding refineries demands substantial investment, with high capital costs and lengthy approval processes often discouraging expansion efforts. Consequently, despite increasing demand for liquid fuels, refining capacity growth has been limited in recent years. U.S. refineries typically operate at high utilization rates to maximize output and capitalize on favorable market conditions, aiming to bolster profitability. However, running near capacity means any disruption can profoundly impact supply stability. Regulatory hurdles, especially changes in environmental standards like sulfur content limits in fuels, drive up operational costs for refineries. These costs are often passed on to consumers, contributing to higher prices and potentially widening profit margins. Not just that, government policies also play a pivotal role in shaping refinery economics. While incentives are offered for certain types of fuel production, traditional oil refineries do not benefit equally, placing them at a competitive disadvantage. This disparity underscores the challenges faced by the refining sector amidst evolving regulatory landscapes and economic pressures. Furthermore, the decline in U.S. refinery capacity over the past 3 years underscores these challenges. Since 2020, capacity has decreased from a peak of 18.98 million barrels per day to 18.27 million barrels per day as of August 2023, with 6 operable petroleum refineries shutting down. These closures, exacerbated by pandemic-related demand lows, have been compounded by ongoing economic and regulatory uncertainties, making it difficult for refineries to reopen. As the refineries ages, long-term maintenance costs and necessary upgrades further strain refinery operations. The Biden administration's energy policies, which aim to reduce fossil fuel reliance, have heightened investor concerns about refining industry profitability. This policy direction has contributed to significant market shifts. Internationally, falling demand for fossil fuels in Europe poses additional risks to U.S. refineries. Analysts predict that a substantial portion of North American refining capacity could face negative profitability margins by 2040, underlining the need for strategic investments and supportive policies to sustain and expand refinery capabilities. Amidst these challenges, the crack spread, a key metric indicating refining margins, has seen significant increases. This spread, which reflects the difference between crude oil prices and refined product prices, has widened due to factors like low petroleum product inventories, rising fuel demand post-pandemic, and reduced global petroleum exports from Russia. These dynamics have pushed gasoline and diesel prices well above historical averages, reinforcing the critical role of refining capacity in stabilizing energy markets and supporting economic resilience. The crack spread serves as a vital indicator in the oil refining industry, reflecting the profitability of converting crude oil into refined products like gasoline and diesel. Widening crack spreads indicate higher margins and increased profitability for refineries. This metric is influenced by various factors that create favorable conditions for refiners. Lower crude oil prices are a primary factor that can widen the crack spread. When crude oil costs less, refineries benefit from cheaper primary inputs, boosting their margins as long as refined product prices remain stable or rise. Factors contributing to lower crude prices include increased global production, reduced geopolitical tensions, or shifts in supply and demand dynamics. In recent years, U.S. refinery capacity constraints have intensified. Since 2020, U.S. refinery production capacity has decreased from 18.98 million barrels per day to 18.27 million barrels per day as of August 2023, with 6 refineries closing. Some closures during the pandemic were due to low fuel demand, exacerbated by ongoing economic and regulatory challenges that hinder reopening. Long-term issues like maintenance costs and required upgrades further strain capacity. Despite these challenges, the widening crack spread has bolstered profitability for remaining refineries. Operating at high utilization rates, nearing maximum capacity, has allowed refineries to capitalize on strong wholesale prices for petroleum products like diesel and gasoline. During summer 2022, U.S. refineries operated at an average utilization rate of 96%, responding to market conditions where product prices outpaced crude oil prices, enhancing profitability. Increased demand for refined oil products is currently shaping the energy market dynamics as economies worldwide recover from the COVID-19 pandemic. The resurgence in economic activity has led to a notable uptick in the consumption of gasoline, diesel, and jet fuel. This trend is further amplified by the resumption of both business and leisure travel, particularly during peak seasons, as more people take to the skies and roads, driving up fuel usage. China plays a pivotal role in global oil demand, influencing the trajectory of the market in significant ways. In 2023, the timing of Chinese lockdowns set it apart from the rest of the world, making it a major driver of global oil demand growth. Out of a total increase of 2.3 million barrels per day in global demand, China contributed over 3/4, adding 1.7 million barrels per day. As the world's second-largest economy, China continues to be a key player in global expansion, although gains are projected to decrease to 540,000 barrels per day as other regions catch up. Over the past decade leading up to 2023, nearly 2/3 of global oil demand growth originated from China, supported by an annual GDP growth rate averaging 6%. Looking ahead to 2024 and 2025, a slowdown in China's economic growth to between 4% and 5%, coupled with increased adoption of technologies like electric vehicles and high-speed rail, is expected to reduce China's share of global oil demand growth to just over 1/3. This shift is likely to keep oil prices elevated and drive up global demand for refined oil products, impacting prices in the U.S. The export market also significantly impacts the profitability of U.S. refineries, particularly in the context of strong demand from international markets, especially emerging economies. Latin America, for example, accounted for approximately 8% of total global refined products demand in 2019, driven primarily by gasoline, diesel, and fuel oil. The region's consumption of transportation fuels has surged alongside economic growth, fueled by a population representing about 8.5% of the world. The U.S. maintains a substantial presence as a major exporter of refined products to Latin America, with exports reaching about 5.5 million barrels per day in 2019, a notable 139% increase over the past decade. Key recipients include Mexico, Brazil, Colombia, Chile, Ecuador, and Panama, which together absorb more than 3/4 of total U.S. exports to the region. Despite plans for new refining capacity investments, economic and political challenges in Latin America have often delayed their implementation. So, in summary, if this bottleneck persists into the foreseeable future, we can expect prolonged higher prices for refined products. With that, let's conclude the video. This is Visionomics signing off.